Welcome to Business Makers Podcast. This is actually our inaugural episode, our first episode. And as you guys, think about how God has called you to take dominion in business, this podcast hopefully will encourage you in that way. God has called us to imitate him. And so we're called to be workers and creators. That's one way we imitate him, is to be workers and creators. In other words, business makers. Business makers exist to equip entrepreneurs, business leaders, and investors to build, grow, and establish businesses for the glory of God. For far too long, Christians have disconnected their faith from their businesses. We have taken our eye off that ball, and liberals actually have better understood what it means to take dominion in businesses than we have, which is why they kind of own the current kind of technology, education infrastructure, media infrastructure, is because they've done a better job of taking dominion than we have. We need to reclaim the center, reclaim the economy, and reclaim what it means to build wealth with meaning, faithfulness, and of course, in submission to God's word. I'm very grateful to have Wilson Hunter on and John Rollins on. They are with Vicinity, both founders of Vicinity Capital. And I'm sure they have a certain, maybe one was a founder first before the other, whatever. A partner. One's a partner, one's a founder. Vicinity is a path to build stronger communities by arming a local legion of investors with a platform to connect and fund and support growth in their local businesses and real estate projects. Interesting. They also help businesses gain brand ambassadors and access capital from their own community. Vicinity is where financial capital meets social capital. Gentlemen, Wilson and John, thank you for coming on the show today.
Hey, thanks for having us.
Yeah. So, kind of straighten me out here. Who founded Vicinity Capital, and what is Vicinity about?
Take it away, Josh.
Yeah. So, John, this may be confusing. So, John, who's not on, was a founding partner along with me, and we started a few years ago, really based on the idea of a few things. One, looking at where just some economic trends, where things were heading, and largely you have more of a decentralized approach to a lot of different businesses, services, et cetera, and a rise of secondary and tertiary markets in a way that was very potent, that took some of the globalized cities and allowed this to really diversify and spread. That, in addition to what we were seeing in capital markets. So my background's finance. I've been in finance for 15 years, and largely I've been involved in growing business over that time, from single state to 38 states, dealt with private equity, dealt with venture capital, been involved in now regulation crowdfunding, which is the business that we're in, as well as nonprofit capital raising. So I've been able to touch on capital raising in a variety of different contexts, see how it works, see what the motivators are, but really seeing this switch with more local economies being a staple of how the country was thriving in different ways, where people were choosing to live, to raise their families, and seeing a gap in the way that people were able to invest. So if you're a high net worth individual, you've typically had some options to invest pretty much how you want. Yet, even with that, if you're not in the right network, in the back of the room deals, then you would miss out on a lot of really good opportunities. So most capital is deployed far and wide, usually anonymously, usually in the stock market, whether that's through mutual funds or your 401k, or even something like Robinhood, which is just painting it in a little bit of a different picture. What most people are locked out of is investing in the things that are actually influencing their communities, that they could help to build and have a mutually beneficial relationship with. So that was a gap. And John and I were talking about this gap and didn't understand why it didn't exist yet, why it wasn't filled yet. And we figured we were probably wrong. Usually if you think you're coming up with a novel idea, you're wrong. What we found out was that we were right, but it was for a reason we didn't realize, and that it was illegal for most of the history of investing. So since the foundation of the SEC, going back to following the the Great Depression, you have a two-tiered system that was created where those that have a lot of wealth can invest how they want, which has been great, still very useful. But those that are under a certain threshold can't choose to do with their money what they want. Well, that actually shifted with new legislation that hit in mid 2016, really started to be deployed in 2017. And that was really the final piece of the puzzle for us when we saw that this is actually, there is an open door here. If we can get through the regulatory side of things, we can actually use this as a tool to bridge those that want to invest, whether they have a lot of money or little money, into projects that are impacting their community, that they expect to thrive, and that they actually want to be a part of. So
John,
it shifted a lot of focus locally.
Yeah, what was that legislation, and what was it creating, and what doors was it opening?
Yeah, so as part of the Jobs Act, particularly Title III of the Jobs Act is what was passed in May of 2016, that opened up for non-accredited investors to be able to participate in private capital raises, but through an online platform. So we are an online platform. If you go to vicinitycapital.com, you will see, yes, a nice landing page, but effectively what we are is a platform that is created and regulated to facilitate investments. So you have to get through a regulatory side of things. But if you use somebody like us, you're now able to connect to these type of investments where you weren't before. So that was a big change that opened up that door.
Have you heard of Start Engine?
Yes. Yeah, they're one of the
so
big players in this same space. So using the same legislation as we are, they do it in a very different way. They have a big popular face on their platform, and they're focused on a lot of moonshot startups, but significant player in the space. Yeah. We're really hitting the niche of connecting dollars to local enterprises and real estate projects.
So with Vicinity Capital, like I don't have much money. Let's say I have $500 or something. I could sign up with Vicinity Capital and invest $500 in whatever projects you guys are doing. Now, you guys control what projects you pick and choose. You guys vet what projects you pick and choose, but I can participate in what you guys are doing. Is that what the legislation allowed for guys like me?
Yeah, exactly. So the minimum investments are set by the issuer, the one that's actually raising the capital, and we become a collaborator and a facilitator alongside them. But many have investment minimums at $500 or $1,000, these entry points that are really accessible, as well as taking very large checks. So it's really mixing everybody in the community together to build the blocks to make it successul.
Is that a kind of massive paperwork issue? Because, let's say I have $500 with whatever you guys are doing, and then, someone's got $10,000 or whatever, but you got, instead of working with 3 investors at $1 million each or whatever, now you're working with 1,000 investors at $500 to $50,000. Is that very difficult?
Yeah, good question, Gabe. It is not. That is one of the things that this has allowed for, is getting the benefit of having a lot of people involved while removing a lot of the downsides of having a lot of people involved. Yeah. So I could nerd out on a lot of the technical stuff, but I'll suffice it to say you basically can aggregate all investors into a special purpose vehicle or an entity that houses all the investors, which then represents one investment on the cap table of a business. So, and then our technology makes it really easy to interact with those investors. So for an issuer that's raising capital, we become a partner not only for the capital raise, but long-term, we view it as investor stewardship, where you're taking care of your investors by providing communications. When it's time to distribute capital, that goes through us as well. So we're able to navigate all of that through the technology that we've built and make it to where it doesn't matter if you have, in some ways, it's almost like you only have one investor as far as they have to handle all the paperwork and the distributions, but you get this broad network of brand ambassadors now behind you.
That's helpful. So what's y'all's focus? Obviously you can't, focus on all things. What's Vicinity's focus then? Yeah,
primarily the businesses we're working with, we do real estate projects. I call it lower middle market real estate projects. So a lot of the buildings that you see around your community, your city, your town, those are going to be anywhere from a couple million to $20 million projects. If you're going to do a redevelopment or you're going to do something like that, anywhere in that realm, we become a part of the equity stack of building out that project. So you can raise up to $5 million in a year using our exemption. So that can be a good amount of equity for a project like that. It doesn't get into the big institutional skyscrapers. Those are a whole different model. And then on the other side, on the business side, good operating businesses that have a solid founding team that are looking to grow, to raise capital, to grow, put to good use, and be able to provide a good return on investment.
You mentioned something that you said something I think is more in passing, but you guys can only raise $5 million per project per year.
Yes, so a project that's part of the legislation as well. Using this particular securities exemption, which is what Reg CF is, a business can raise up to $5 million over a 12-month period. So once 12 months has passed, that it's almost like a rolling line. You could start that over. You could raise more capital, but they're limited. So we're not. We could do as many projects as we believe we could facilitate well, and that there's interest in. But a particular business would be capped at no more than $5 million in that given 12-month period.
Okay. So Gabe owns a business. I work with Vicinity Capital. I can only raise $5 million through Vicinity Capital max
for that year.
12 months,
and then if another year comes up and you're ready to do another raise, then great. So it does that in itself streamlines what type of businesses we're working with. A lot of times they're going to be a certain size project or a certain size company that are looking to really hit the gas. It captures a lot, but it definitely is a certain tier of businesses.
That's super helpful. Before we went on air, Josh was just saying how Wilson was going to be doing all the talking.
Apparently something a little different than that, but yeah.
Wilson, what's your role with Vicinity?
Yeah, so I'm a partner here at Vicinity, joining a couple months ago. My background, I started a couple tech companies, venture capital, fundraising. I did a Reg CF for one of my own businesses. And then Josh and I go to church together. So we became good friends over the past year, aligned values on this opportunity, and joined up with him recently. So
that's helpful. So kind of reading y'all's website, it looked like you guys largely invest in like just South Carolina, or is your investment bigger than that? You talk a lot about kind of community investment and stuff.
Yeah. So we're based here in Greenville, South Carolina. So that has naturally been where our initial footprint is. Though we've done deals in North Carolina as well. That's represented a pretty sizable portion. To date, we've done 15 deals. So we're still building out that portfolio. But North Carolina, South Carolina, we had one in Birmingham, Alabama. I'd say the Southeast is the larger of our footprint right now. But the goal is to try to have a high density of investors in a particular region to support projects that are going on in that region. So we do see it kind of growing and more of that way of having that epicenter and then sort of spreading out from there.
So normally, you guys aren't like a typical like VC, fund.
Correct.
What's the distinction between like a VC fund and what Vicinity Capital's doing?
Yeah. So venture capital would be a lot of times they're like you're describing. Somebody would put together a fund. You would have limited partners enter that fund, and then through that, they're choosing companies that they're investing in based on a certain thesis. A lot of times they're looking for those moonshot startups, those that are going to be 10x plus
10x,
type of returns, and very risky, and a lot of times very complex. So they're not something that just any investor could really understand and get into. You might be talking, biotechnology, something where there's a level of expertise that can be served well there, versus something that's more of a community play where I can see, feel, and touch this project in my backyard. I understand this business. I'm a customer at this business. The business model is one that's very graspable. That would be more of in the realm of what we do. So where there's an advantage to have a public marketing campaign effectively for your capital raise, an advantage to connect with your network and your potentially your customers, that's where what we do is really unmatched. That's part of the beauty of what doors have opened up this way. So a little bit of a different profile. So we're friends with a few of the venture firms that are around our region, and see a lot of just abilities to direct capital into a variety of different projects. There's very little overlap in the types of businesses they would support and invest in, and the raises that we would facilitate. And to your point, we're not a fund. So they're raising capital and then choosing to deploy. We're not doing that. We're not raising capital and then Josh and Wilson are making decisions on where the capital goes. We're saying we can be a platform for you to pitch your business and connect with your audience. And we've got a process that we feel like is really good. Every deal we've launched so far has been successful. So we have a good playbook on here's how we would work through a system to see if you're ready to raise capital. If you are, this is how we think it can go well.
Okay.
And you get to connect with investors that are either already in our network that are connected through our platform, or those that are in your network that you get to bring in and open up access where you haven't been able to before.
Okay. So typical VC, let's say Gabe's company comes to this VC and I'm asking for, let's say 2.5 million or whatever. That VC is just going to say, okay, yeah, thumbs up or thumbs down. We're going to vet you and we're going to go through this process, thumbs up or thumbs down. You guys, you're going to vet me, but really what you're vetting me for is, are you a good candidate for your platform? And then it's kind of almost like a capitalistic approach to, hey, I'm trying to win your audience over, your Vicinity Capital's investors over, and then they decide, oh yeah, I'll put money into this project. So you guys aren't deciding how to, let's say, you guys aren't deciding where the money goes per se. You're bringing forward 15 projects and, hey, who wants to fund which kind of thing?
Yeah, we're an intermediary, not a fiduciary of funds. So, for example, we have over 1,000 investor users on our platform that will see deals and make their own decisions on each deal. But we're an intermediary for the deals.
I see. And are you intermediary for the deals you got nationwide people logging into Vicinity and using it?
We do have people all over the country. I'd say it's a higher density around where we've done a deal. So most of the deals that we've done, I'd say at least 80% of the capital is coming from their local region, the county or right around them, which is proving our model. That's great. But you also have people, you could have a business owner that lived in Dallas for a long time, built up a good network there, then moved to Greenville and is doing something here. Well, that's still your network that you've built trust with. That's still kind of part of your community, and they could invest. So I'd say a starting place is you have a community around you that you just haven't been able to open up access to. So that's step one. If you have people around you that want to invest and you just haven't been able to do that, this makes that really easy, really compliant, and very streamlined. We become a partner with you along that. And then you get to augment their reach by opening this up to a broad network of investors, potential investors that have never heard of you. So it basically builds momentum off of those that are already supporting you, that you think want to invest or that you can now connect with. And then from there, it can help to really go a lot further than you could just on your own.
So how does what's the cut that you guys get on a deal? What's the ROI? Let's say Gabe invests with Vicinity, or I set up an account, I log in, etc., and I invest, $1,000, whatever, with Vicinity. What's my expected ROI generally, and then what's the cut that you guys take in this whole process?
Yeah. So our process, one of the reasons that we want to make sure everything's a good fit and we feel like there's a good chance of success is our model is contingent on the success of a raise. So we make money if the business raises the capital that they're targeting to make. It's set up as a basically a commission structure. So you should just budget that in, as there's always costs of raising capital. There's legal, there's accounting, there's any kind of partner or intermediary, and a variety of other things, marketing costs and all that. So we say, look, we actually bundle a bunch of that through what we do, and that's what you're getting there. And then we can also help you understand what other costs and partnerships you need on the legal side and the accounting side. So for us, typically it's a 6% of the capital raised. When you have a successful raise, we're getting 6% of that, and then we're getting 2% of the capital raised in the form of securities. So we've actually put 25% of our revenue on the company that we're facilitating, and saying we have skin in the game just like any investor would. So if it goes well, then Vicinity has basically a portfolio of all of these local companies that we're helping to raise capital with. If it doesn't go well, then we have risk just like any investor that's coming in. So that's that side. So, on the investor side,
clarify there. You get a commission cut of the raise, and then you get equity in the business that you raised for. And you said 2% on that?
Yeah, not 2% of the company, but 2% of whatever was raised. So if it was $1 million raise, it was like we invested $20,000. We were like a $20,000 investor in the project. So it's a small percentage, but for us, it's a portion of our revenue that we're basically putting at risk there to say we're also behind the company. We have skin in the game on the companies that we're facilitating, and it's on the same exact terms as any investor. So it's not a special deal. So Gabe, if you were investing, Vicinity's chunk there of the equity would be or of the debt. We do debt. You can do debt. You can do unique forms of raising capital and structures. So from an investor standpoint, there's very much an it depends answer. The different types of businesses, if it's real estate and you have an asset that's backing the investment, sometimes definitely the terms will look a little bit different. The downside is a little lower usually, because at least that's the perception there, is because you have an asset that can sell. It's harder to go to zero. If it's a business, you're probably expecting more upside, but you might also have there's a risk that it could fail. You could lose your money more. So all of those, I really like to hold to age-old truths where still you want diversification to be a part of this. So if you're investing on Vicinity and you can actually get into a handful of deals instead of just one, that can be a really good way of building up what is an alternative asset class. The idea here is that these types of investments can exceed typical market returns, but you need to be smart with how you're investing and how much and in what deals you're investing to try to create a good portfolio.
Right. So basically, y'all's vetting process is hopefully going to help the investors participating in Vicinity Capital with higher returns, or
Yes.
more standardized returns also. If that makes sense.
Yeah, well, and largely, so you might have a deal, we might do a deal that, let's say me personally, I would say, well, I like to invest like this. Well, we might host a deal that is not going to fit exactly what would be my risk appetite or profile or what I'm looking for at that given time. But as long as it's being clearly presented to an investor, we're showing them, here's the good, here's the risks. We want to present something where if somebody says, yeah, that's exactly what I'm looking for, I could lose my money, but I really like the upside of this one, then we want to make that accessible. So we're not honing it to where it's just a very set terms that somebody is looking for each and every deal. We do want the language to be there to where it's very understandable. So if somebody comes on our platform, they know where to go to see the financial returns or the pro forma, to know what a pro forma is and what it should look like, to understand some of these basic investment concepts. So even at smaller investment levels, you can start to build up an acumen and an understanding and a skill set of investing that then can grow as you become more and more sophisticated in the process.
Yeah, we've hosted less than 5% of the deals that we've looked at. So diligencing the deals is definitely part of the service and the value add there.
So 95% of the deals that have come to you guys, you've turned down.
That's right.
What you're saying. Wow.
Yeah, for one reason or another. A lot of times it's a mutual realization that it's not time to raise capital. A lot of times it's just not being aligned with maybe the way that we would go about it. Just a variety of things that could lead to that. And then some, we would just say, we don't see this as the right time to host this.
What would keep me from, why would, let's say I start up my own company, I put sweat equity into it. What would keep me, let's say, from, why would I not want to use, friends and family investment and maybe go to Vicinity and lose 6% of my raise or something like that?
Sure. So a lot of times you should. That would be a great way to get started as first money into your business before you really have proven anything, but you need some capital and some people that trust you to roll up your sleeves and really do a good job. That is going to be family, friends. Sometimes, though, it's hard to set terms in a way that are typically good. Usually, so we live in raising capital. Most business owners, they don't do this all the time. So it can be really easy to put those family and friends in a bad situation unintentionally. Nobody's trying to do that, but it can be really easy to do that. And also, this can be a way to not only hone the terms and what you're offering, but then broaden the reach. So family and friends can be basically like the lead investor, where they can help build momentum, but then you're opening up to a broader network to come in and accelerate that. One of the things we look for is, do you have that close money around you that can get things started? Because if not, it's a little bit of a flag for us on maybe the terms aren't there, the business isn't there. you don't have the right makings for this to be a successful capital raise.
Okay. Go ahead, Wilson.
Yeah. So our average deal size is 750,000. So, this also gets into some of the reasons why you're doing the podcast and some of the big higher level questions, but there's an aspect of a platform like ours allowing for folks who don't have, 750K from their immediate friends and their family members, which is probably most Americans, to be able to access their local community, people that support them, but may not be close enough to support them with private deals, may not be, that close to them to be able to facilitate a raise at the early stage of their business. So that's a big benefit of Reg CF for seed capital.
That's very helpful. I got 2 questions that we're actually going to answer on Twitter Spaces. So people are going to have to go kind of track down that Twitter Spaces here. The Twitter Spaces will have happened on Friday. You'll be getting the show on Monday. So you're going to have to go find the Twitter Spaces. But the 2 questions I want you guys to start with is what does it, how do you guys vet? What are some of the principles? What are some of the specifics you're looking for when you vet? And then secondly, what's kind of one of your biggest victories, your biggest ROIs, your biggest wins with Vicinity Capital? We're going to answer that on Twitter Spaces, so you got to stick around or actually go find that. And we'll be on YouTube Live and Rumble, so you can go find that to hear more from Josh and Wilson. Thank you guys so much for coming on Business Makers Podcast.
Thanks for having us.
Thank you.
Be sure, tune in every Monday. Every Monday, we're going to be dropping an episode with Business Makers, and it's actually a jam-packed schedule. We have a lot of business leaders, venture capitalists, owners, entrepreneurs that are going to be coming on the podcast. So we hope this really does encourage you to build your own company, become an entrepreneur, and grow what God has put in front of you in your life. So until next week, love God with all your heart, soul, mind, and strength. This almost sounds like a cross-politic close-off. Go fight, laugh, and feast. This is Business Makers.